Don't you hate getting cut off? Okay, this is part 3. November 30th, NetSolutions paid creditors on account $950, so that's a decrease to your liability of accounts payable, which would be a debit, and a decrease to your asset of cash, which would be a credit. Chris Clark determined that the cost of supplies on hand on November 30th was $550. Okay, so let's go back for a second. You had bought supplies in a previous example of $1,350, I believe. So what that looked like was this. Okay, what that had looked like was this. You had debits to supplies of $1,350. That's when you bought the supplies. Supplies are an asset. All right, these are your paper clips, your pencils, your whatever you need. Okay, highlighters, print cartridges, so on and so forth. That's how I think of it anyway. So you had $1,350 in supplies. Now, to go back with what the example had told you, it told you that the cost of supplies on hand was $550. So what you basically did, sorry about that. What you basically did is you went into your supply closet and you realized that there were only $550 worth of supplies left. All right. So what that means is you had $1,350 in here, and now when you go to count it all and you see how many are left, you realize there's only $550 in supplies on hand. Well, how do you get from here to here? During the course of the month, running your business, you must have spent $800 worth of those supplies. Okay? And that's fair. You needed supplies in order to run your business. You needed paper. You needed postage stamps. You needed highlighters. You needed those things in order to run your business. So, the supply expense of doing your business this month was $800. You got $1,350 minus $800 leaves you with $550 in supplies at the end of the month, and that's what you want to get. Okay, so during the course of the month, you used up $800 in supplies in order to run your business. So what that's going to look like is this. You've got a debit to supply expense of $800, and you've got a credit to supplies of $800. And that will give you the appropriate amount of $550 left into the supplies account. Okay, let's go back to over here. Alright, so there's your journal entry, the same one I just did on screen. Alright, November 30th, NetSolutions paid $2,000 of dividends to stockholders. Okay, well, as a business goes, you just know that $2,000 of your cash went out the door. So here's your credit to cash of $2,000. On the other side of things, dividends actually brings the value of your business down, in the sense of your business no longer has $2,000 that it had before. So if you go to that owner's equity T account that I showed you in the beginning, that's going to be dividends is on the left side because it's lowering the value of your business. It's on the minus. It's going to be a debit to dividends of $2,000. Alright, I'm not entirely sure I'm going to go through every one in these slides, but at least some of the new terms I'll go through for you guys. NetSolutions paid a premium of $2,400 for an insurance policy for liability, theft, and fire. The policy covers a 1-year period. When you pay for a service in advance, whether it be a magazine subscription or a cell phone or whatever the case may be, that's going to be called a prepaid account. Okay, so in this case you paid in advance for an entire year $2,400 for an insurance policy. So with that, you decrease your cash by $2,400, but you also now have this asset of prepaid insurance. So for anything that you see as prepaid, that's going to be an asset to you. Okay, NetSolutions paid rent for December. It's for December's rent. So in order to run your business this month, you needed a place to run your business out of, right? So with that, that's a debit to rent expense, all right? You need that in order to run your business. And here's your credit to cash for the $800 that you paid for the rent. Okay, this is an interesting one. Okay, NetSolutions received an offer from a local retailer to rent the land purchased on November 5th. Okay, so what happens is we have a big vacant piece of land. Let's put this in regular terms. And we haven't done anything with this land. So somebody came to us and said, hey, can we borrow that land and park on it for 3 months and we'll pay you for it? And we say, sure, we weren't planning on doing anything with that land anyway. So NetSolutions agreed to rent the land to the retailer for 3 months with the rent payable in advance. So what happened, let's see, next slide. NetSolutions received $360 for 3 months rent for use of its land. So what happens is, that's 3 months worth of rent. We got $360 in cash, so here's our debit to cash of $360. And on the flip side, we have something you haven't seen before. You've got unearned rent. Unearned rent is a liability. Remember I said liabilities mean you owe somebody something. In this case, you owe somebody a service, and that service is letting them park on your land for the next 3 months. All right, so with that, you've got a liability of unearned rent. If you see the words unearned rent, unearned somewhere, that basically means you have a liability of some point. All right, unearned should make you think to yourself, oh, that's a liability. Okay, they don't take it the next step here, but I think I'm going to take it the next step. The next step is, as the months go on, as it becomes, say, December 31st, or no, rather January 1st, and we've let those people park on our lawn for an entire month, what we're going to do is we're going to take it out of unearned rent. It would be a debit to unearned rent of $120, right? You see that because $360 for 3 months of rent. It would be a debit to unearned rent of $120 and a credit to rent revenue for $120. Okay, so as what happens as time goes on, let's see, we'll clear this one. No, clear this one. As time goes on, you've got unearned rent. And here's your T account for unearned rent. What happens here is originally you've got $360 in there. And we've got rent revenue over here. Shows the T account. And you get nothing in here. That's what I left the cash one off here because I think you're okay with cash as cash. But the idea is that we have this $360 liability here. Now it's for 3 months. As each month passes, we earn a little bit of that money, that rent money, because we've been letting them park on our lawn. So what that's going to be is it's going to be a debit to unearned rent. And now that we've earned the money, we get to record a credit to rent revenue. So every month, as time passes, we're going to make the same journal entry. $120 here, another $120 here. And finally, at the end of the 3rd month, when we provided our full service, we've got a final $120 here and a final $120 here. So at the end of the month, after we're done performing our service, we have no further liability to anybody for this unearned rent. And, oops, too far. We've got $360 of rent revenue. And that's how that works. Okay. Get back to these slides. All right, we bought, in this one, we bought a piece of office equipment for $1,800. So we get the office equipment, which is an asset, that's a debit. And on the flip side, we have a payable. You see the words on account here. We have liability to Executive Supply Company for $1,800. Okay? This is going to come into play in a future one in a few minutes, so keep this one in mind. NetSolutions paid $180 for a newspaper advertisement. Well, that's going to be a debit to expense. You needed that advertisement to run your business. You're trying to get your business going. Then they call it a miscellaneous expense here. I would have maybe, if it were my business, I might have called it an advertising expense. There's no like set rule in stone about how you should classify things, but I would go with advertising expense because that's the one that makes the most sense. And a credit to cash because you paid the $180. NetSolutions paid creditors $400. Okay, you owed people money, so here's your credit to cash of $400, and here's your reduction of the liability of accounts payable, $400. We paid a receptionist and a part-time assistant $950 for 2 weeks of wages. We need that person to work for us so we can run our business. So here's our debit to wage expense and our credit to cash. Now some of you guys may be wondering what these numbers are in here. What these numbers are in here is the numbers that are associated with the particular ledgers. We talked about ledgers a couple of minutes ago. Ledgers are the subsidiary backup statements. So if at any point, if I wanted to know what the total wage expense I had spent for the year was, I would go to ledger number 51 and see how much wage expense I had for the year. That's how that works. NetSolutions received $3,100 from fees earned for the first half of December. Okay, so we got our cash that we received, and we record the revenue that we earned. Now let's say, okay, here we go. Here's reaching back to a minute ago when I said we bought like a desk or something from Executive Supply Company. Well, we had an $1,800 bill, and we're paying half of it right now, and that's fine, okay? May not be fine with the Executive Supply Company, but it's fine for a journal entry. The idea here is that we're paying out the cash, and we're sending them in half of their money. So before you had $1,800 in liabilities, now with this debit to accounts payable, you only have $900 in liabilities. NetSolutions received $650 from customers and payments to their accounts. Okay, so people who owed us money have now sent in their checks. So we received the cash and we reduced the accounts receivable. Okay, when they owe us money, we increase the accounts receivable, which is debit. When they pay us what they owe us, then we credit it to reduce it. Because they no longer owe it to us, they've given us the cash. NetSolutions paid $1,450 for supplies. So we got supplies, $1,450, and we credit to cash. Increase the asset of supplies, decrease the asset of cash. I always get a kick out of this one because it's like you went into Staples with $1,400 in your pocket and bought supplies. NetSolutions paid the receptionist, part-time assistant, $1,200. The same journal entry we did before, debit to wage expense, credit to cash. NetSolutions paid its $310 telephone bill for the month. Well, here's our debit to utilities expense. Telephones fall under utilities, so there's your expense. You need the telephone to run your business, and here's your credit to cash for $310. NetSolutions paid $225 for electric usage. Well, electric usage also falls under utilities. The point of these two problems is to let you know that utilities encompasses more than just the gas or electric. It can also encompass telephones or anything, or cable, whatever may be, the case may be. So you've got your debit against utilities expense and the credit to cash. NetSolutions received $2,870 from fees earned for the second half of December. Same entry as you had before. You received the cash, credit to fees earned. And this one, we earned $1,120 on account, ding, 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 for the second half of December. So we earned the money, so we're going to record the fees earned here. But we didn't actually get the cash yet. Remember, recording the revenue has nothing to do with when you receive the cash. You did your job, you record the revenue, period, end of story. In this case, the revenue is called fees earned. On the other side, when people owe you money, it's called an account receivable. So basically, you put the bills in the mail and you're just waiting for the cash to come rolling in. NetSolutions paid $2,000 of dividends to stockholders. So here we go. Here's our credit to cash because money's coming out of our business, and our debit to dividends. And last slide. At the end of all this, you do all of these journal entries all month long. All these things are happening. Bills are coming in the mail. We're going out and we're buying supplies. We're doing our job and earning money. All these things are happening. We're entering them in the general journal, and then we're updating the individual ledgers, which I don't think is mentioned. What I mentioned before was when you're updating those individual ledgers, that's called posting. And that's happening all month long. So at the end of the month, what we're going to do is we're going to prepare what's called a trial balance. And what a trial balance does, and this really should say unadjusted trial balance, all right, rather than just trial balance here, because it's a little bit more accurate. Because we're going to be doing another trial balance at the end of Chapter 3, and it's going to be an adjusted trial balance. So right now we've got an unadjusted trial balance. And all that it tells you when you do this trial balance is whether or not all of the debits equal all of the credits. It doesn't tell you whether or not you've debited or credited the right accounts. It just makes sure that of all these journal entries that we've been doing, all of the debits match all of the credits. So we didn't debit an account for $1,000 and then credit a different account for $1,200. That's all you're doing with the trial balance. It's almost like a first check to make sure you didn't make any mistakes. So at this point you've got an unadjusted trial balance. That's the end of our chapter. And I sincerely hope this has helped you get through this material if you had any questions about anything you've been doing. And if you would like to, then do your Chapter 2 homework and move on to, hopefully I'll have Chapter 3 recorded in time for you to learn it. Have a great day.